Net present value is a very important concept in business. It's used all of the time to determine a course of action, to make an investment, to develop a building, a warehouse. And it's simply the present value of all the cash flows for any particular investment or project after having accounted for all the revenues and costs. So once we calculate the next net present value, if it's positive, it implies the discounted revenues are greater than the discounted costs and the project should be done. If the net present value is negative, then the discounted costs exceed the discounted revenues and the project should not be done. So here's a real-life example of a net present value calculation. Assume we are going to set up a tea franchise. Our initial outlay to set up our franchise is going to be $1,100, and we require a rate of return of 10%. And here's a table of the cash revenues and expenses. In year one, we'll get $1,000 of revenue and we'll have $1,000 of expenses. In year two, our revenues have grown to $2,000 and our expenses have grown to $1,500. And in year three, $2,500 worth of revenues and $1,000 worth of expenses. So let's look at the net present value of our tea franchise. We have the $1,100 cash flow out, our initial investment. We had no net cash flows in the first year, $500 positive net cash flows in the second year, and $1,500 net cash flows in the third year. Discounting that all back, it becomes a net positive present value of $440, so the project should be done. All right, let's walk through another example with some twists. We have a project that provides annual cash flows of $500 for 10 years and costs $2,000 today. What's the net present value if the required return is 8%? What's the net present value if the required return is 25%? And what discount rate will give a 0 net present value? At 8%, our net present value, again, our $500 discounted by our 8%. Then our calculation here that we've looked at before, again, taking it to the 10th power, minus our $2,000 initial, gives us a positive net present value of $1,366. So at an 8% required return, this project should be done. Now, exact same project, exact same cash flows. The only difference is we now require a 25% return. Same calculation, but the net present value is minus $215. So at minus $215, we would not do this project. And what rate of return makes it exactly 0 where we would be indifferent? And if we solve for this, you would find it to be 21.41%. So at 21.41% required return, you would really be indifferent. You might do it, couldn't do it, whatever, you'd be completely indifferent there. At 25% required return, no thank you. And at the 8% return, you'd have a net present value and would want to do the project. So let's look at another example of net present value usage. We're thinking about setting up a restaurant. It's going to produce a cash inflow of $42,000 the first year, and then those cash flows will grow 10% forever. So this is a growing perpetuity. It's going to require an initial investment of $600,000. So if we require a 16% return on our investment, should we set up the restaurant? All right, let's look at the numbers for our hypothetical restaurant. We have our $42,000 a year cash flow in perpetuity, our 16% required rate of return, our growth rate of 10%. So the difference between those divided by that minus the $600,000 initial investment gives us a positive net present value of $100,000. So we would certainly want to undertake this project. Now, what if we're not totally sure that that 10% was going to come true? at what growth rate would it be break even in a net present value sense? So what we're basically going to solve for is we're going to solve for that growth rate here. Same calculation. We get to a 7, and then that growth rate would be a 9% growth rate to make sure we're break even. All right, let's talk about two concepts, sunk and opportunity costs. Sunk costs are those costs incurred prior to the decision of whether to do the project. So they should not be taken into account. They have already been spent, they are out the door, we can't recover them in any way. So whether the project is done or not, the sunk costs are incurred. Opportunity cost. Opportunity cost is money that is given up rather than paid if the project is done. The firm doesn't necessarily explicitly pay opportunity costs, but it gives up the money that is available to it to do the project. So basically the project is going to use resources of the firm that it's not going to have available to it to do other projects that might earn a different or higher return. For example, if you decide to start your own business, you should account for the time you're going to spend on that business. Even though you own your own time, it's not free. There is an opportunity cost. You could take another job, you could start a different kind of business, so the cost of that needs to be taken into account in your calculation. Now, in this example, we're planning to put together a computer leasing business. We've paid a consultant $5,000 for a market survey, and she's given us this information. You could buy 1,000 computers for $2 million and rent out each computer for $1,400 the first year, $1,200 the second year, and after that time the computers will be worth nothing. They'll have no salvage value. Depreciation for tax purposes, straight line over 2 years. Now, with a few more details on our hypothetical computer leasing business, we have some office space that we own that we could alternatively rent out for $30,000 a year. And instead of doing this business, we could earn another $100,000 a year doing something else. The tax rate is 34% and the discount rate we require is 10%. What is the net present value of this project? So the first thing we need to figure out is what is the EBIT, the earnings before interest and taxes. So our depreciation, if you remember, is straight line over 2 years. The computer costs were $2 million divided by 2, so our depreciation equals $1 million per year. Let's continue to work through our calculations. Our earnings before interest and taxes in the first year is our $1.4 million in revenue minus our $1 million in depreciation, and that gives us an EBIT the first year of $400,000. In our second year, remember, our revenues decline a bit to $1.2 million. Again, minus our straight line depreciation here of $1 million, leaves us with an EBIT of $200,000. Our tax calculation is as follows. We have $400,000 of income from here times our 34% rate, and that gives us a tax bill of $136,000. In our second year, we have our EBIT of $200,000 times our tax rate again of 34%, and that gives us a tax bill here of $68,000. So far so good. Let's calculate our net income. We take our, for the first year, our $400,000 of EBIT minus our tax bill of $136,000 gives us a net income of $264,000. In the second year, $200,000 of EBIT minus our $68,000 tax bill equals 132K of net income. Let's talk about our operating cash flows. That's the money you're actually going to keep. We have our net income from the first year of $264,000, and we're going to add back our depreciation amount. Depreciation is a non-cash expense on the income statement, so we're going to add that $1 million of depreciation back in to give us an operating cash flow of $1,264,000 in the first year. Same calculation in the second year. Take our $132,000 of net income, add back in our depreciation for a net operating cash flow of $132,000. Okay? All right, now that we've got all the building blocks of the calculation done, let's do the calculation and find out net present value. We have to consider our opportunity costs here first. So remember, we had $100,000 worth of income we gave up. We gave up $30,000 worth of rent that on our office space we could have given up, we could have had. We want to multiply that by 1 minus the tax rate of 34% to get a net cash figure, and that would equal $85,800 in opportunity cost. We subtract that $85,800 from the net operating cash flows in year 1, which would give us $1,178,200. Divide that by our required rate of return, and in the second year that becomes $1,046,200, again divided by our 1,012, now taken to the power of 2 because we're in the second year, minus our $2 million initial investment. One point I want to make here, in no calculation here did I subtract that $5,000 we spent for our consultant. That is a sunk cost and not considered in the calculation. Remember that. Anyway, continuing on with this calculation, it gives us a net present value of a negative $64,281, and so this project should not be done.